If you're thinking about buying or refinancing a rental property, the loan is only one part of the decision. The bigger question is whether the property, the financing, the rent, the expenses, and your long-term plan all make sense together. That's what makes investment property financing different from financing a home you plan to live in. The lender still reviews the loan, but you also need to think like an investor. The first step is to define the goal. Are you buying your first rental property, adding another property to your portfolio, buying a small multifamily property, refinancing a rental you already own, or using equity from one property to help buy another? That goal affects the loan structure, the down payment, the rent analysis, and the questions you need to ask. Next, understand the numbers. With a rental property, the monthly mortgage payment matters, but it's not the whole picture. You also need to think about property taxes, insurance, HOA dues, vacancy, repairs, maintenance, property management, and cash reserves. A property can look affordable based on the mortgage payment and still produce weak cash flow once the real operating expenses are included. That doesn't automatically make it a bad investment, but it should be an intentional decision, not a surprise after closing. Qualification also works differently with investment properties. For a traditional investment property loan, the lender reviews your income, debts, credit, assets, down payment, reserves, the property, and the expected rental income. For some investors, a debt service coverage ratio loan, or DSCR loan, may be a sensible option. With the DSCR loan, the lender focuses on whether the property's rental income supports the proposed payment, rather than focusing primarily on your personal income and debts. That doesn't mean the loan has no requirements. Credit, down payment, reserves, rent documentation, appraisal, property type, title, insurance, and program rules still matter. In all cases, the property matters. The lender needs to understand the property value, condition, number of units, rent potential, title, insurance, and whether the property fits the loan program. A single-family rental, condo, duplex, fourplex, short-term rental, and small apartment building can each raise different financing questions. Short-term rentals deserve special attention because income can vary, local rules may apply, and HOA or condo restrictions can affect whether the property works for the intended use. One common surprise is that rental income may not count exactly the way you expect. The lender may use lease information, rent history, market rent from the appraisal, or other acceptable documentation. The rent figure used for the loan may be different from the rent you expect as an investor. Another surprise is that investment property loans often require more cash than primary residence loans. In addition to down payment and closing costs, most loans require cash reserves after closing. The best next step is not to memorize every rule. The best step is to understand your goal, estimate the numbers, and ask early whether the property and loan structure fit together. At Texas Lone Star Lending, we believe it should be okay to ask questions. Our job is to help you understand the mortgage side of the decision so you can make a smarter investment property choice. That's why we're your loan educator.